Financial statement review and ratio analysis are key tools that help managers, investors, and other stakeholders understand how a business is performing. Companies face many challenges like competition and limited resources, so it's important to have clear information to support decisions about growth and stability. Financial statements, such as the income statement, balance sheet, and cash flow statement, provide a summary of a company's financial activities over a certain period. But looking at these numbers alone doesn't give the full picture. That's where ratio analysis comes in. It takes these numbers and compares them in different ways to reveal important relationships and trends, making it easier to assess financial health and performance. In this session, we'll explore how financial statement review and ratio analysis work together as a structured method to evaluate a company's performance. We'll also discuss why it's valuable in business, how to carry it out, real-life examples, and some of the benefits and limitations involved. Overall, this approach is an essential part of modern business analysis. Financial statement review is a detailed look at a company's published financial reports to understand how well it is operating, what its financial position is, and whether it can sustain its cash flow. Building on this, ratio analysis translates relationships between financial items into numbers, which helps identify trends over time, compare performance with competitors, and evaluate strengths and weaknesses across different areas. Together, these methods offer a practical way to analyze a business without relying only on outside forecasts or complicated valuation models. They are valuable for various stakeholders. Management uses ratios to keep track of profitability and efficiency. Liquidity and solvency ratios reveal a firm's ability to meet obligations, and overall, ratio analysis supports key decisions about pricing, cost management, financing, and optimizing working capital. Investors, creditors, and regulators use ratio analysis to assess a company's financial health, risks, and compliance with regulations. Ratios also help businesses compare themselves to competitors, giving insight into their market position and strengths within the industry. To conduct a thorough financial statement review and ratio analysis, start by qualitatively examining the core financial statements, the income statement to understand revenue trends and profitability, the balance sheet to look at asset quality and liquidity, and the cash flow statement to analyze cash generation and investment activities. This foundational review sets the stage for more detailed quantitative analysis. Next, focus on profitability ratios, which measure how effectively a company generates earnings from its assets and equity. Important ratios to consider here include gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. These ratios provide a clear picture of the firm's earning power and operational efficiency. Strong profitability is a sign that a company manages its costs well, has pricing power, and operates efficiently, which helps ensure long-term success. Liquidity ratios focus on a company's ability to cover short-term obligations, with key measures like the current ratio, quick ratio, and cash ratio. Maintaining adequate liquidity is important because it keeps operations running smoothly and builds confidence among stakeholders, especially during uncertain economic times. Efficiency ratios look at how well a company uses its assets, and include inventory turnover, receivables turnover, payables turnover, and total asset turnover. Higher efficiency ratios suggest disciplined management and better asset use, leading to improved profitability and cash flow. Solvency ratios assess long-term financial health and risk, with important metrics being the debt-to-equity ratio, debt ratio, and interest coverage ratio. Having a balanced level of debt supports growth, but too much debt can expose the company to financial trouble during downturns. Additionally, modern financial analysis increasingly values cash flow ratios because they provide insight based on actual cash movements, which are critical for understanding financial stability. Operating cash flow ratio, free cash flow, and cash flow coverage ratios help confirm that reported profits actually translate into cash, which is critical for a company's sustainability and ability to make strategic decisions. These ratios are widely used in real-world applications. For example, boards of directors analyze ratio trends to gauge management effectiveness, spotting potential issues like squeezing profit margins or rising debt. Banks and lenders use liquidity and solvency ratios to assess if borrowers can repay loans and to manage credit risk effectively. Companies also compare their profitability and efficiency ratios against industry benchmarks to spot strengths and weaknesses, helping them stay competitive. Beyond business, governments and nonprofit organizations rely on ratio analysis to evaluate financial stewardship, ensuring resources are used efficiently and sustainably, rather than focusing on shareholder returns. The main advantages of these financial reviews and ratio analyses are their simplicity and clarity. They turn complicated financial data into easy-to-understand metrics that anyone can use, and their effectiveness in making meaningful comparisons across time and between organizations. Ratios are valuable because they allow us to compare performance across different time periods, business units, and competitors. One key advantage is that declining ratios can serve as early warning signals, helping to identify financial stress or operational inefficiencies before they become serious problems. Another benefit is the low cost and accessibility of this analysis, since financial statements are usually publicly available, making ratio analysis cost-effective. However, there are also some limitations to keep in mind. Ratios are based on historical data, so they may not accurately predict future conditions. Variations in accounting policies between companies can distort comparisons, and ratios don't capture qualitative factors like management quality, innovation, or brand strength. There's also a risk of misinterpretation if ratios are examined in isolation without considering other metrics or the broader context. To get the most reliable insights, it's best to use multiple ratios rather than relying on just one. Combine financial and cash flow metrics, compare ratios over time and against peers, and incorporate qualitative business insights. This balanced approach helps create a more complete and accurate picture of a company's financial health. Financial statement review and ratio analysis are key tools for understanding how well an organization is performing financially. By looking closely at profitability, liquidity, efficiency, and solvency, decision-makers can get important insights into how effectively the business is running and how financially stable it is. While these methods rely on historical data and accounting judgments, which means they have some limitations, they still provide a reliable foundation for financial analysis when used thoughtfully and in the right context. When combined with a broader strategic view and looking ahead to future possibilities, these analyses help guide smart decision-making, careful financial management, and support the long-term success of the organization.